Welcome to Monday Night Live, the weekly training that guides professionals to financial prosperity. Join our community and let's start building your wealth.
Mark Ritter he's like me, is from Pennsylvania. I mean, I don't live there now, but actually was just up there over the weekend. But we met as a result of hosting him on our podcast, the Massive Passive Cash Flow podcast, and did an excellent job, excellent subject, near and dear to all of our hearts, which is part A, getting loans for real estate investing from credit unions. Normally, we don't talk about that. We just talk about borrowing in general from traditional um, for-profit banks. But credit unions have been an excellent source of funding. I mean, for me too, by the way. In the past, it's usually easier. It's actually often even less expensive when it comes to fees. They're generally member owned, so there's other benefits there. They're a nonprofit. Okay. Um, and also, Mark is very helpful in helping people get SBA loans. If you have a small business that you're running or starting, he's an excellent resource there too. In fact, one of our you probably know Ron Williams. His wife is underneath us. She's not an active member of the team, but she's in EXP underneath us, and Ron has a program called Hoodle that many of you are actually on. So there may be an opportunity there for Ron and Mark. Did you guys meet, Mark? You and Ron
Yes.
and
Yep. We're having
okay.
some active discussions.
Oh, excellent. Okay, yeah. Hopefully he's a candidate because his program is actually really good right now in new construction. Oh my gosh. Um, so Mark, if you want to, let's go ahead and get things started. If I'll let you go ahead and introduce yourself, if you wouldn't mind. Give everybody a background so there's some context there, and then you
Sure.
can screen, you can share a PowerPoint if you have that, anything you need, and I'll man the chat box for you.
Yeah, sounds good. I'm going to flip it over to my talking points in a little bit. Today, I really wanted to talk about credit unions, kind of who we are, what we are, the state of the world. But also, if you indulge me a little bit, I want to nerd out with kind of what's going on behind the scenes in the lending markets. So that way you can understand the conversations with your lenders, what you're hearing when you're trying to put together deals. Hopefully, you pick up some points that will help you out in the future. So, I'm going to go ahead and share I'm Mark Ritter. And by day, I'm the CEO of a company called MBFS, which stands for Member Business Financial Services. That's a mouthful, so I just call it MBFS. And I also am in the podcast hosting business, and I like to go on podcasts really just to spread the word about credit unions as much as promoting our business. A lot of people don't understand what we are, who we are, how to access them. But I've been in the credit union area for 25 years now. And I've really focused on just real estate investing and small business lending through credit unions. So that's kind of, and when I started in this, the credit union business lending space was just a fraction of a fraction of a fraction of the marketplace, and it's grown quite a bit. Last year I moved from the suburbs of Philadelphia up to Sullivan County, Pennsylvania. Nobody here knows where that is because it's tucked away in the mountains. I'm in a beautiful lake community, and the whole county is about 5,800 people. So I'm up in the woods and I enjoy it and travel quite a bit to the cities and with businesses and real estate investors. Love to connect with people on LinkedIn if I can help you out. I also have my personal website that tells a little bit more about me and the business, markritter.com. And our company website is mbfs.org. So a little bit about who we are, MBFS. So we were formed back in 2008, and we are owned by 13 credit unions. I'm the CEO, But we are a company that's 100% owned by credit unions, and it's for one purpose. It's for credit unions and their members who just need real estate investment loans and business loans. We work with over 100 credit unions nationwide. The easy way to think about this is instead of every credit union and going and forming their own commercial lending department, buying all the systems and people and credit analysts and software, because it's millions in investment these days, they contract with us to do that and to help them out on the back end. And we help people get started with business lending programs. We have a team of originators who hopefully you're working with someday, who help their credit unions members connect, and they process the loans and talk you through, and really that day-to-day relationship, just like any other bank loan officer that you may know. So, and we help out really with the whole back end of the loans through credit analysis. We help the documentation, and we service the loans and currently have a portfolio of about 2.7 billion. But as Gary mentioned, we also help out with SBA and USDA loans. They're the best deals going today. The market's as friendly as they've ever been. You can get great terms and conditions and a lot more money, and with longer periods of time with the SBA than you ever could. All right, just talk a little bit about credit unions and kind of some of the numbers behind us. There's over 4,500 credit unions these days, which is more than double the amount of banks out there. We tend to be smaller, but there's 140 million members of credit unions today. It's a huge percentage of the country are credit union members today, and we have over 2 trillion in assets in the industry. So over the last 12 months, we gave out 28.8 billion in loans to real estate investors and small business owners. We're even in the declining markets. It's been a brutal market these last 12 months. We've done almost 29 billion, with the vast majority of that going to real estate investors. And there's currently $160 billion in loans collectively among credit unions out to real estate investors. And even if you're just in the mortgage world, if you're a real estate agent, they're still very active. In the last 12 months, they've done 132 billion just for residential real estate. And there's 720 billion that credit unions hold to mortgages. People think of us as, the place you got your car loan when your parents signed you up as an account. But back when you were a kid, but we're really quite substantive and have grown into much more larger, complex institutions than back in the old days. But I always say, if I went to a bank, I'd probably get fired within a week. A lot of people don't realize what a credit union is. You drive past and you see the branch and the ATMs and auto loans and everything, but it's really a local cooperative that's owned by the people, just like any other cooperative. The people who have accounts are members. And it's ran by a board of directors that's democratically elected by the membership every year. So if you have a membership account, you probably, get the notices to vote. And it's important that you do. You're part of the cooperative and can influence it. And if you ever want to join a nice people, a networking group of people in your community, you call them up and say, I'd like to be involved as a volunteer. And it's a great group of people to be involved with. The other piece that I like about credit unions is that we're reliable. Credit unions aren't formed by the local guys. And Gary, do you have your hands up?
Oh, no, sorry, that's a mistake. Sorry,
Okay.
let me lower that.
Don't want to ignore
Yeah.
you.
No, that's okay.
So, credit unions are reliable. They're not formed by a local group of investors in hopes of building it up and sending it, selling it off to a bigger bank someday. They're in the market to be in the market today, tomorrow, yesterday. So when you find a good relationship with a credit union, you can feel confident that source is going to be there. When I was in the banking world before, it sometimes felt like we were in a product one day, we were out of a product one day. New management would come in and the whole thing would turn over and we'd have a new focus. Credit unions are really for their community. So as a result, particularly if in the credit union community, you can get much more personalized service. Your app, even with us, your applications don't go into a black box out of town and it spits out a yes or no. You're dealing, if you want to come in and meet the executives of the credit union, you ask and you can do it. You can feel comfortable with them. And I always say people should be interviewing their financial institution as much as they're interviewing you. And with a credit union, you can do that. You don't have to feel like every time there's a merger or a consolidation, you're moving down the food chain. And by nature, they are relationship-based institutions. You're going to be asked about your personal deposits. You're going to be asked about your auto loan. You're going to say, can we help you in your investments? What are your goals? It's not just the easiest thing for me to do is just give somebody a loan and say, thank you, have a good day. But we really really want to focus on that relationship and helping people out in the long term instead of a transaction. And I don't know about you, but I hear it a lot. And that's, everybody always says they want relationship banking. And with a credit union, by definition, you are part of that organization.
Mm-hmm.
So I'm going to nerd out for a little bit here and probably get into some numbers. And some of you will like this and some of you will glaze over. But just indulge me for a minute because it's important that you understand what's going on behind the scenes at your institutions and people that you talk with. And what you'll see is some of these trends also impact local banks and the regional banks just as much, if not more exaggerated. So I'm going to start on the left side here as I look at the screen and talk about loan growth, which is in the dark line, versus share growth. Now, in the credit union world, we call deposits shares. It goes way back when. I wish they would just call it deposits. But as you notice here, in 2020, that yellow line, that number skyrocketed, absolutely skyrocketed over near 25% with the number of deposits flooding in to institutions. Why was that? All the stimulus money we got from COVID. And rates were plummeting because the money was so flowing in so freely. Now, what you see is at the end of 2020, and I'm sorry, the end of 2021, beginning of 2022, what you saw was deposit growth plummet and absolutely plummet into 2023. And 2023 was one of the worst years was the worst year on record for deposits flowing into financial institutions. Now, the loan market absolutely skyrocketed. It kind of puttered along there. It's pretty consistent. And actually the COVID years were actually pretty good for us. And 2021, 2022 were absolute skyrocketing years for loan growth. If you know a lender, if you know a banker, they were living pretty good and they should have been buying dinner in 2022.
Mhm.
However, because the deposits fell off in 2023, loan growth plummeted as well. And really, loan growth, went down to about 4.6%, which was anemic. And deposit growth at one point was down to about 1%, which is, it's, as you know, it's not even keeping up with inflation. So those deposits were eroding. Now, simultaneously, you saw over history, credit unions' yield on loans the past decade has been pretty good. I'm looking at the right column here. We invest some money and it makes a pretty good yield. And then in the cost of funds was pretty flat. And then you see that green line, which is the cost of funds, has more than tripled in a very short period of time. This is the problem. If you're talking to your lender friends and banker friends, the cost of funds is just skyrocketing. And not only is the cost of funds skyrocketing, what's happening when you really look underneath the covers is, we all have savings accounts or money markets, and we all have our checking accounts, and we don't get any interest on that. We might get 0.25% interest. Well, those cheap deposits are eroding and just plummeting every single month. And the only deposits they're getting are the high cost deposits of around 5% plus. So we have, over on the left side, we have deposit growth plummeting. They have their costs increasing like crazy. And even loan demand is still stable and strong. So you're really seeing a squeeze in your lending when it comes to liquidity. Now, also what's happening during COVID, everybody, when COVID started, we all gathered around and said, oh my goodness, deposits are going to, or delinquency is going to skyrocket. Delinquency did not skyrocket. And it actually went the other way. And you see the yellow line there as the rolling charge-offs of loans and the rolling delinquencies. And it is just increasing. So we are finally getting that COVID bounce of delinquencies and charge-offs. And to make matters worse, years ago at the Great Recession, they implemented a new allowance for loan loss methodology, which has skyrocketed the amount that banks and credit unions have to reserve for future losses. So you are seeing liquidity drop, and every time they make a loan, it costs a tremendous amount to put it away for reserves for future loan losses. So as a result, we use a ratio a lot in our business called loan to share. So over on the left side, you saw the dark number is how many deposits we have to how many loans we have. And during COVID, that number plummeted because we were flush with deposits. And as you saw that shift of the deposits stopped coming in, liquidity at institutions plummeted. And we have a lot less money people had a lot less money to lend. And even on the right side, what you see is cash and short-term investments. And that's what people use to lend out to people like yourself. The amount of cash available to lend out plummeted. So the moral of this story is when you talk to a lender, you used to assume that when you knocked on the door of your bank or credit union and said, I need money, and you would assume they have money. Now you really have to find out if they have money to lend. Now I'm giving you the inside baseball here, and nobody will ever look at you and say, we don't have money to lend. But what they do is they cut down LTVs, they raise rates, they manage the liquidity through rates and terms and conditions. They will make it so they tighten the credit criteria. They don't just say, you haven't changed, we just don't have any cash. They just make it more difficult for you to lend and turn you away. So you really need to have those conversations of, tell me about your liquidity and ability to lend. Because it has swung on historic levels like we will never see again. You know, the best thing that could happen for me right now is another pandemic, because it was the greatest days we ever had in the lending environment. That was more money than anybody could ever imagine, and rates were cheap. Now rates are much higher, and there is much less liquidity to lend out. But so I'm going to talk a little bit now and kind of get into today's marketplace. You know, credit unions, with the growth of credit unions, they've really taken the place of community banks from 25 years ago. There are still some good community banks out there, but most of them have a new sign in front of them as they keep getting merged up. So credit unions, I really truly believe, you know, we're that place when you talk about, I want to walk in and meet with somebody about the loan in my marketplace. That's where you can go. The other interesting item is, if you want to join a credit union, you have to qualify to be in that credit union. Now, my father's credit union, when he was working 20 years ago, they had his factory credit union, and to open an account there, you had to work at that factory. That was it. In most credit unions historically grew up where it was maybe a local military base, a local factory, a local group of teachers, some bond. That's really gone. If you see a credit union in your neighborhood that you drive past, I'm going to say there's a 95% chance you can walk in and open an account, and they have ways that you could join. So, and also, so when you see that credit union, don't feel the block. At one point, you were right to feel like, I probably can't go open an account there. Today, you can go open an account there. What we're seeing today in our lending environment, the multifamily unit space is as strong as it's ever been. Demand is off the charts. Everybody who has properties, we are still strong into the multifamily area. We're strong in the self-storage. Believe it or not, even some retail environments are still strong. You know, cold storage facilities are off the chart right now. But really, that demand for the multi-family is really good, and our credit unions are lending into it. Where we're seeing the most challenges is, you know, what I say is, the bigger the property in the bigger marketplace, the bigger problems you have. If you're in a second, third tier environment, a lot of those properties, even in office, are fairly stable. It's the biggest properties. If you look at some of these office towers in downtowns, it's mind-numbing how much money people are losing on some of these deals. But, like one of our owners is Erie, Pennsylvania, Erie Federal Credit Union in Erie, Pennsylvania. Commuting and work from home is not a problem. If you're in Erie, you can drive from one end of the metro area to the other in 30 minutes. Everything's it's pretty fine and pretty stable, and they're not seeing a blip in it. So really those second and third tier cities, the smaller properties, the smaller projects, they're just moving along just fine. One of the challenges that we're seeing from is the debt service coverage ratios. When we make a loan, believe it or not, we want to show that it can pay the bills and you can pay us back. So if those numbers are less than 1-to-1, we want to have a conversation. When rates were 3.5%, you had a lot of margin for error. In today's world, when we're doing loans at 7 to 7.5%, you have a lot less room for error in terms of your expenses, how much you purchase it for, and can you make the numbers work? That is by far and away our biggest challenge today, where we will sit down with somebody and show them the numbers. And typically what's happening is we're having people bring more equity to the table to get those numbers down to where they make sense. So we're still doing loans. We're very active in loans. We have a lot of credit unions. Typically today, what we're seeing is between 7.25. Some deals may get up to 7.5. We do see those rates starting. We think they're very stable. If anything, they'll be going down. Most of the time for us as a real estate investor, you're in the 75% LTV range. And sometimes if it gets cut down, it's more has to do with making the numbers in cash flow. One of the items that I am most proud of with credit unions is that when you deal with a federal credit union, you will never have a prepayment penalty. Now, a lot of times, another inside baseball piece is when you get a residential loan, when you get a consumer loan, everything is in your favor and you're going to be given 20 pages of disclosures. When you do an investment loan, nothing is in your favor and you're expected to read everything. Most people don't. So when rates were 3.5%, nobody cared about a prepayment penalty. Now you should really care about a prepayment penalty, because when you're getting 7.5% at the top of the market, when these loans go down by a point and a half, I don't know when that's going to happen, but it's going to happen. The first thing you're going to want to do is refinance your loans. And if your lender has you locked in on a prepayment penalty, and that's usually the thing that you never looked at and never read and never asked about, you're going to be surprised when you're locked into a higher interest rate. So that is as important as I could have stressed today, is understanding that prepayment penalty. So really what we like to do is, we like to connect people with credit unions. We deal with 100 credit unions nationwide. So, if people connect with us, if we don't have a local credit union that you can work with, what we do is we have friends all over the country in every corner of this world that are similar companies to us, similar credit unions, and we try to match them up with local credit unions who are in the investment real estate lending marketplace. It's the first time I would not say credit unions are stable money. Credit unions are fair money. Credit unions are not, I need a quick settlement within a week. I would need fast cash, no money down. You're not going to look at my credit. That's not what a credit union is. We give fair rates. We give transparent rates. We are very friendly on fees, but we're going to look and make sure that it's a credit-worthy transaction. And the first time, the first time tends to be the most difficult, more because we want to understand you as much as you want to understand us. So like I said, I really enjoy the credit union marketplace, as you can tell. I hope that shows through. So I'll kind of open it up for questions about anything that you have on your mind about the lending marketplace, things that you've seen, things that you're curious about, things about credit unions that you might have seen.
One thing, Mark, I think a lot of people, everybody's always asking, what do you think is going to happen? And I've learned that success leaves clues, history leaves clues. But it just seems like in the last couple of years, it's really there's so many variables, and something could change overnight that you aren't even anticipating. But the one thing that really stuck out in my mind here was the low liquidity level. How many deposits are actually available there to lend out, and there's not much. And of course, the demand is starting to increase again because the consumers are tired of waiting. They were waiting for the price increases. They were waiting through the rate increases. They're just ready they just want to go out and build something or buy something. But when it's like that, obviously raising rates is one of the ways banks can kind of quell the demand, so to speak. But the demand we're seeing it around the country. The transaction volume is increasing. And it was weird. It wasn't like the typical March, April, May. It was more like June and here in July. Just all of a sudden, out of the blue, we saw. I mean, what kind of things are you seeing, or what's the industry anticipating as far as liquidity and rates go? Knowing we're in an election year.
So we really think that there is going to be, even when rates come down, there's going to be a prolonged activity, a prolonged level, 3 to 4 years of tightened liquidity at institutions. Mm-hmm. And the reason we think that is when you look at the consumer lending, consumer spending patterns. I don't know if anybody's heard this, but eggs and bacon cost a lot more these days than they did 4 years ago. So if you think about your personal pattern, you get paid. Then you go to the grocery store and you go for gas, and your paycheck, which is those low cost deposits, are just getting chewed up of your bank account. So personal savings rates of those low cost deposits are just continue to get killed. And we don't see an end to that, because there's a lot of room before you start seeing personal savings rates increase. So we really think if you have money to save and money, a little bit extra money, shop around because you can get some good deals. Now, when it comes to lowering rates, there is no institution that's saying, well, we really think rates are going to increase, barring some black swan event. But even when rates decrease, what you really want to look at isn't so much the prime rate, because all the headlines are on the prime rate. But in our world, your banks and credit unions aren't so much following the prime rate as they're following the treasury rates. And that's what you want to watch. Now, that money tends to be a little bit smarter and follow macro level events well in advance. Mm-hmm. So particularly on those 5-year treasury rates, if be smarter than your lender, because when you start seeing those 5 and 10-year treasury rates moving down, your lenders should be moving down as well. And if they say, oh, the prime rate didn't move, well, that's not what you're lending off of. Prime rate is a short-term rate. You really need to, watch the indexes of those treasury rates. And that'll give you a much, much better indicator of when you're going to see the markets go down. Now, I think there's still an outside shot that rates move down in September. All the data says that they should move in September. If they don't, it's more for political reasons. It's not wanting to interfere with the election. The Fed meets 2 days after the election, and there's a massive percent chance that rates will be adjusted then.
Okay. Well, let me ask you, if you don't mind, do the loans that you're seeing being made from credit unions, do they also get involved with new construction? Like it's, you do a new construction loan, generally you do it in draws,
Yep.
And then, okay.
We do new construction loans.
Mm-hmm.
Honestly, we have, I can't think of, we've done about 2 new construction loans in the past 12 months. And that's more of an indicator of uncertainty and the interest rate environments.
Mm-hmm.
Because, the juice that you're paying during that construction process has more than doubled in making the numbers work. And there's been a lot of uncertainty about people's ability to find contractors to get the job done. There's a lot of that cost of construction has skyrocketed so much. Interestingly enough, the price of lumber has plummeted to pre-recession levels. But go ask your contractor how far they're booked out and what their staffing levels are like. So that's been the bigger issues. Demand, if you built a multifamily project, could you fill it? Absolutely. Particularly in some markets. Can you do it cost effectively? Oh boy, that's the tougher issue right now. That's the tougher question right now.
Yeah. Yeah. I know people personally who are doing large remodeling projects, and some material, like you said, the wood's gone down, but some material, like sinks, toilets, things like that, um, uh, natural stone have all gone through the roof. But the real problem is the labor cost. The days of getting somebody out there for 50, 75 bucks an hour, that's gone. Yeah.
Yes.
I mean, they're telling us they're charging us 100 bucks an hour. I mean, I'm not doing right now, but that's what the contractors are saying. Hey, we're charging minimum 100 an hour because that's what it takes for us to get the job done and be able to buy food for our family. The cost of gas, the vehicles that they've had to purchase the last couple of years, they've all gone. Everything's gone up.
And unfortunately, we always look at it and say the solution for high costs are high costs, because eventually people just won't need to pay it and the whole thing will spiral downhill. So, kind of like the price of gas, it'll go up, 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 and then eventually it slows down and people will move off. So it will change at one point, but then if you start seeing a deflationary environment, to me, that would be worse for us and for the environment, because if you see a deflationary environment, that means the people who pay your rents are making less money.
Mm-hmm. Yeah. Yeah. Well, it's probably right now, I would say it's a safe bet, or a good, a sound statement to say, if you own real estate now, it's best to hang on to it.
Yes.
I mean, what's funny is I come from a banking background, but I don't know that I've ever seen in 40 years the combination of the rapid price increases followed by rate increases that generally quell demand. Demand's still there. It's just now it's loosening up a little bit here and there. We're seeing people actually do more in new construction is what we're seeing. Um, but the the other factor of having a housing shortage, a national housing shortage, I don't know that we've ever seen that at the same time as these other factors. I don't know that there's a historical equivalent just to look back and say, okay, this is likely what's going to happen, you know?
Well,
Uh,
and as you know, I'll give we believe population shifts are really impacting the housing markets. And Pennsylvania is a great example where Southeast Pennsylvania is booming. There's steady growth, steady demand, marketplace is up. And for a lot of the rest of the state is the Rust Belt, where you continue to see population growth, where people are shifting to higher market areas, so, higher growth areas. So, that you're really seeing a concentration of population. It's not, you don't work in small towns in Western Pennsylvania where there's a factory anymore. You grow, graduate, and move.
Hi, I just want to take a moment to thank you for watching a recording of the Monday Night Live class. Hope you're getting a lot out of it. I'm sure you will. I wanted to let you know that, you can come to Monday Night Live whenever you want, but you can also participate more with the team. Why don't you set up a call with me, a one-on-one strategy call? I can go over everything with you, show you everything that we have to offer. For example, did you know that on our team, not only do you get your leads, we actually give you your own account on our lead gen system. So this puts you in control. You're not waiting on somebody to hand you leads. You get to pick the ones you want. Okay. Huge difference. We have 21 of our own proprietary marketing campaigns. They're all copyright protected. We're the only ones that can use them. Okay. The coaching is absolutely one-on-one. We got 3 coaches. We even have a 4th success coach that we have access to. Okay. One of left fewer than 100 in the world. Okay. One-on-one coaching. Right now the big problem is volume. We need more transactions. We need more inventory. I get it. Well, we know how to get it. Our team actually outproduces the national average by more than 2 to 1. So if you're struggling, don't do that anymore. If you're a solo agent, if you're a team, let's just talk. Smart entrepreneurs are always open to discussion. Learn what we have to offer, and then you can make an informed decision about staying where you are or moving on. You got to decide, if you're not where you want to be, you've got to take action to get where you want to be. Let's see how we can help you do that. I look forward to talking to you. Click on the link, set up a call. And by the way, I'll see you on the next Monday Night Live.
hey, is anybody on tonight uh, actively working with any new construction? Any of your buyers building a new home, or you're at, or you're or you have in the last year?
I'm doing one, Gary.
Okay, and you're San Antonio or up by Normal Lake Austin?
San Antonio.
Okay, did the lender did they get a regular bank loan? Because the reason I'm asking, I've had a few people tell me the builders are actually lending the money. Has anybody seen that before? The builders are the ones they have. I don't know where they're getting the money from.
Well, the builder incentives in San Antonio have, we've seen a lot of more incentives, to build and to get in and to do that. I mean, the one I'm doing, I basically, I got private money and hard money to get it done, but I didn't have any trouble finding contractors, and my pricing was pretty much what I expected it to be. So maybe that's just our market.
I was just going to say, Kay, as you were, there's actually a glut of private money out there and hard money. There's actually a lot of money sitting on the sidelines looking for the money to get out the doors, because they're looking for higher returns.
Yeah.
Yeah. And I think is Anna. I think I saw Anna Galumian raise her hand. Or says, Anna, are you still on?
I'm still on. Hi, everyone.
Hey, Anna.
Yes, I do a lot of new construction in the San Antonio and the Austin area. And honestly, one of the biggest reasons that I advise new construction, especially in this market, is because of the unbelievable builder incentives that are being offered. Like for example, I recently closed for a VA loan, about $45,000 in price discounts plus concessions, on a home that's sub 300. So that was a pretty awesome deal package. And then I'm able to get a lot of movement with a lot of these builders. I've sort of identified which sales reps, which communities, which builders have a lot more flexibility and incentives to go after that. But that being said, I do have a challenge serving two primary categories of people. One, not every builder is willing to offer the same amount of incentives for external lenders. So, like for example, religious-based lending, when I have individuals that I have to help, that need to have specific types of interest-free financing, not every builder is willing to work with them, and not everyone is willing to extend nearly half as many of the incentives to them since they can't use their internal lenders. And then the other category of people that are more challenging for builders to work with are investors. So sometimes builders, especially Austin, they blocked off investor purchases for during majority of the COVID period. When they did reopen it back up, they normally do that on select homes within the community if
Mhm.
that community offers any. So that category is still challenging.
So Anna, if you there's actually several credit unions across the country that are ethnic group based and religious group based. For example, there's one here in the area that's a Ukrainian credit union, a Polish credit union, but we also have several Islamic credit unions to have different norms behind interest rates and how interest is done. So if you connect with Gary and tell me a little bit of the specifics, I can try to match you up with somebody that might make sense.
That's amazing, Mark. Honestly, that would be phenomenal. Because, like I said, there, especially in the Austin market, when I have investors who are looking for the builder incentive specifically, or the religious based, yeah, I would absolutely love to connect. Thank you so much for that.
Yeah, yeah, some of them we might work with and some might we don't, but I could certainly, kind of give you help point you in the right direction.
I appreciate that, Mark. Thank you so much.
And Anna, I'm just curious. I think did you say before you were one of the users of Hoodle, RonWilliamsHoodle.com?
I
Is that
am, yes, yes, I am. He's put together a phenomenal platform
Mhm.
to basically bridge the gap between real estate and new construction. So anyone who is interested in getting into the new construction space, it totally elevates the game. I've been doing new construction for over a year. Quite a bit of my transactions on the buy side are new construction, a large majority of them actually. But on the Hoodle side right now, it really elevates the game to now talking on a developmental type of basis. So land development kind of discussions, listing kind of discussions. So it elevates you from just being a buyer's agent for builders to really being that go-to person with developers and with builders. So yes, it's a wonderful program.
We really see
okay?
the new construction side as it's very regionalized. In some markets, Texas, there's plenty of space for outward expansion. There's so and you have a government regulations that are friendly to it. Other areas, um, you know, don't move to New Jersey. So
No.
No,
So
I completely agree with you, Mark. My sister's out in California and she is hard pressed to find any builder communities in the areas that she services because they're so built out. They're so well developed already. So I could imagine that being a challenge in a lot of regions across the country. But in areas that do have expansions going on, I want to say a large majority of the agents that I network with have some kind of new construction going on, whether it's in the metro area itself or on the outskirts. But you're absolutely right. It is very much a regional type of movement.
Okay, awesome. And Shastine, if you want to mute yourself, looks like you've got your hand up also.
Yeah, I was just going to add that what I've been seeing for builders, besides them, there's certain builders that will buy a bunch of loans bulk at a lower percentage rate and offer those to buyers. So that's what we're doing on two different builders. They are buying them at around just under 5% and offering that to the buyers. Also, another builder now rolled out for first-time home buyers, a 2.99, where again, they're buying certain amounts of loan products. I don't know, a certain number of loans down for buyers and then putting certain conditions on them is what I'm seeing. And then also sometimes you have to ask the sales reps because sometimes they'll say, $15,000 incentive from builder or from using the builder's lender. However, if you ask the sales reps, sometimes you'll find that really it's the builder that's giving the incentive, but yet the lender's maybe just kicking off $1,500 or so. And so in that instance, I've gone back and just reduced the price by $15,000 and had their preferred lender just kick in the difference if I had a client that was more only qualified at a certain price point and we're looking a little bit higher. So those are just things to kind of keep in mind when we're kind of, trying to find a good price for our clients and we're looking at new construction.
And I just want to add to that, Shastine, a lot of times, and I don't know how it is in your market, my market, 90% of the builders that are well established enough to have the funds to do the pool purchases with the loan products, they're also ones that have internal lenders. So they have, at the very least that I have seen, 60% ownership of the lending institution that they work with. So that to them, it's kind of a balancing act of identifying what is more paramount to your client. Oftentimes, if it's closing costs or if they need to reduce the price point, they're almost one in the same entity more often than not, in my market at least.
Right, agreed.
Yeah, well, one common denominator here is it seems like the incentives are really big right now with the builders. The speaker we had on last week, oh shoot, and Tony Antoinette, she was a DR working for DRB, Dan Ryan Builders, and they had some pretty good incentives. And those weren't the most expensive homes either. They were probably, 250 to 450,000 price range. Some of the incentives are pretty big. Some of them are like 21,000, like 5%. That's a huge incentive, So, okay, let's see what questions you guys have. I mean, you've got a CEO here, MBFS. Clearly, he knows his craft, and I know for me, guys, in the past, I used to be a member of a credit union, and it was Navy Federal, one of the biggest that there is, and I got my home finance for that. I got my car financed to them. Um, just an amazing, and it was so easy because you're a member. Hey, Mark, would you mind digging in a little bit deeper on what it means to the consumer, like for them to be a member of a credit union, what that really means versus going to, Wells Fargo, for example, for a loan? I mean, it's just to me, it's like you said, it was community bank, it was community oriented, and
much less expensive. Yeah, and that's one of the keys with it is I would call it much more mission focused on looking at the person holistically versus just a transaction.
Mhm.
And, credit unions, especially in today's rates, are holding mortgages. So if you have, maybe that good credit or it's a little more difficult, and outside the box, you can many times talk to that credit union and look to make it work because you're dealing with a person and having a conversation. There's always those, 10% of the people at the top and 10% of the people at the bottom that can go anywhere. And then there's always a group of people that, I'm sorry, I can't help it no matter what you do. But really, most people are in that world in between where it's nice to have that, even if you don't need them today, sometimes it's nice to have that credit union relationship with a local lender that you can pull out when you need that special deal, when you need that help, or if somebody has an account with a local credit union, already, they're much more likely let's look to make the deal work rather than fitting in its box. So one of the slides that they talked about is, you have to understand where the money comes from your lender. And a lot of times people don't get that because the mortgages sometimes that you're talking about, it has to fit a box and then it has to fit an outside investor who they can sell it off to. Credit unions, if they have $1 of deposits, they're lending 82 cents today out in loans. So it's their money and it's their money that they're keeping. So that gives them more flexibility in working with people as opposed to just simply working for a outside investor. Even that's what you see with a lot of your banks. It's not that local money in the deposits. It's just simply borrowed money, and it has to meet a certain threshold, and then they can push it out the door. So sometimes people don't know where the money that they're getting comes from ultimately, because that's who you're actually the threshold that you're lending to.
Yeah. Yeah. A lot of banks are actually using a big commercial line of credit. That's what they're doing. They're drawing from a line of credit that they're paying 3% on, and they're lending it out at 7%. Somebody's asking, Dutch is asking, do credit unions get involved with fractional lending? I guess that's where they're selling okay.
Yeah, and that's what, when you look at the number, that's what it is. They're lending their money. And, so that's why they also can tend to have a little bit more margin. They're lending out $1 of deposits and they're lending it at 82 cents. They're lending 82 cents of that. Even on a high side, if a high one, maybe 95%, where they're lending out 95 cents. But they're sitting there with a cost of funds at 1.8% today, and that's really skyrocketed. So they can lend out that money at a pretty good interest rate and have plenty of room to wiggle room. But it's not like a bank where it keeps leveraging over and over many times more than your actual deposits.
Yeah. I think in traditional or conventional banking, where they're packaging up their loans and selling them to Wall Street, at the end of the day, that original money, granted, each time it's brought back and lent it out again, brought back and lent out. But I think that that's up to 10 times before they get to the point there's not enough left to lend out, But in a credit union, I mean, if they do that, would they maybe do it once, or they
do sell some traditional mortgages off to Fannie and Freddie. But that's really a much, many times they continue to hold it internally, and that's simply an asset liability management decision.
Yeah. Well, it does make it easier for borrowers too. I mean, because you're right, a lender who keeps the loan in-house can be much more flexible than a lender who's selling the mortgages, because the rules are much more strict,
Yep. And Valerie had a question about accessing credit unions outside of your area. So, Valerie, what I would say is you're best to use a credit union. Like if you're in live in San Antonio, Texas, and are doing a deal in Pennsylvania, you would be better off finding credit unions who are Pennsylvania-based credit unions. Now, that's where people like me come into play, because what we actually do is matchmaker for credit unions. Now, there are many, many credit unions that will lend on a nationwide basis or a large regional basis. So if you, when you do that, you're better off going to one that's a little bit bigger, and not the one branch corner of the credit union in a small town.
I just wanted to add, I've been with credit unions are actually how I got involved with the financial side of life. They were offering really cool programs as a teenager in my local area, where you take classes and you're able to get credit cards. So my credit card history started when I was 15. And so I've been loyal to credit unions ever since. And every single time there's any HELOC or high equity type of loan product out there, loan situation, or even commercial loans, credit unions are like my first go-to. And I have to say, for anyone who has clients who are trying to pull their equity, call your credit union for any kind of HELOC program, because they have the best rates. And so, yeah, hi fan, a very, very strong fan of yours and the credit unions, Mark.
Well, thank you. And that's really what I mean when you talk about relationship banking, is it's an institution that you can have for life instead of, being with them for a little bit and then they go away.
Yep. Okay.
I have a
Hey,
basic
Mark.
question.
Oh,
if I
go
may.
ahead. Sorry, Jeff. Yeah.
Mark, I really appreciate you geeking out on the statistics and the numbers. That was pretty insightful. The way you presented that data was akin to listening to Lawrence Yun, the NAR's economist. So my question is, how often could I listen to you, or where could I listen to you on like a quarterly basis when you do an update on what's going on, especially in the credit union market?
So my podcast is designed just for that. What's going on in the credit union industry? We talk a lot about the trends and what's going on, and what's working and what doesn't. So we do. It's on every audio platform out there. If you search up Credit Union Conversations.
Excellent.
So
I will.
and what I always like to tell you is, what we like to do is to help people out. So anybody on this call, if you're trying to put together a deal and just seeing something weird, something odd, you're being told something that doesn't make sense, connect with me and we could at least try to translate what's going on to help get that deal done, whether it involves us or not.
Fantastic. And then the other question that I had is, how can I find out if you're working with any credit unions here in Massachusetts?
Just shoot me the area, and I'll get you some. Shoot me the town and area, and we have a couple up there. And if we don't have one directly, I have some good friends in that area that I wouldn't mind making an introduction to.
All right, great. Thank you very much.
Okay. Guys, go ahead and ask away while we're here. And Mark, it is 6:08. I want to respect your time. If you do have to go, feel free. I generally stay on till about 8:30 for Q&A. Usually it's around the same subject. You're welcome to hang around, but
so I'll kind of throw it out there for any final questions, and then I'll probably hop off. But I'm not in any urgent, but I'll let you guys.
Okay.
I have a question.
Yes.
Do most of the credit unions require points Or is that just if they want to buy down the rate?
They don't require it. Credit unions tend to be much more friendlier in terms of points and not paying, okay, we're going to pay this down. Some of them do. They have tiers on points, but that's when you see much more into the secondary market pricing.
Okay. Thank you.
Hey, Mark, I have a question too. It's sort of a theoretical question. Most folks on here tonight are real estate agents from various real estate brokers companies, and my team, of course, here is we're on from EXP, but we got people on from Coldwell Banker, Remax, Keller Williams, you name it, and a few investors too. What would you say if you were to guess, looking ahead the next 23 years, what would you say the opportunities that we should be looking for, or what should we be excited about? What should we be preparing for as real estate agents in terms of what type of business, investment business, new construction, resale, that type of thing,
Yeah, I really think you're going to see a lot of incentives towards renovating property. I think you're going to see houses become smaller, more efficient, more compact. Part of that would be due to cost. Part of that is, we're not going back to, you're not getting the 2.5% mortgage anytime soon, at least on a traditional 30-year fix. So I think you're going to be seeing smaller, more units, more efficient use of space, which is really where we're seeing the long-term trends in renovating properties, changing the use of properties to get there, because interest rates are going to stay up, barring black swan event out of nowhere. Interest rates are going to be what I'll call historically normal. And some people who have the gray hair like I do, that you're going to be back to that historically normal types of rates, historically normal returns.
Yeah.
So
okay.
okay.
What I heard in all that? Who here is thinking flipping? We're talking about repurposing space and remodeling, and we need inventory. We need housing. Sounds like a good flipping environment to me.
Yeah.
So
Yeah, there's going to be a lot of opportunities in renovations and moving up. So, okay.
Well, the rental market, I think the rental market is going to continue to increase too. I mean, when I look at state legislation and state programs and federal, or the lack thereof, it's really leaning towards a more of a renter population. There's not any, like in California, there's nothing for new home buyers. It's all about providing low income housing.
Here's what to keep an eye on.
Mhm.
The Tax Cuts and Job Act of 2017 virtually eliminated the tax benefits for owning a home. And the rental market, with the increase in standard deductions and the limitations on mortgage interest, very, other than the, setting aside the I own a home versus renting a home, the year-to-year financial incentives really were wiped out for 90+% of the country. If that law sunsets and we roll back to 2016 tax rules, their state and local taxes will be fully deductible. It would flip from a rental market to a home buyer market. Now, I don't think that law is going to, I think that law is going to be extended, but that is definitely something to watch politically because that is going to impact the value of renting versus the value of buying.
Yeah.
Many people forgot all the changes that went into that law. And the headlines now is just what's going on in terms of the tax rates. but that really impacted the mortgage markets.
Yeah. Well, at the end of the day, to me, it just comes down to working with investors. I mean, because wherever there's adversity, uncertainty, there's opportunity. And I
We-
look at, yeah, go ahead.
We have an
Yeah.
inherent lack of inventory in this home, in this country. Other than,
Yeah.
some of the markets, there's an inherent lack of inventory. So, and that is not going to be changing anytime soon.
Yeah.
So,
So
all right. Well,
wherever
I'm
we can, yeah.
yeah.
Yeah,
So
go ahead,
Gary
Mark.
has my contact information. If anybody, today, tomorrow, in the future, kind of has a question and I can help you out, please feel free to do so.
Okay. Well, Mark, thanks for taking your precious time to this. I know it's evening and dinner time, and so we're very, very appreciative. You gave us a lot of good insight, facts and data, and also helping us interpret that so we know how to prepare looking ahead of you next couple years. Do you guys mind if you wouldn't mind typing in the chat box, thank you, or hand raise, or you can unmute yourself if you want to, because this is, I'm kind of a nerd myself, Mark, so I really appreciate this class.
All right. Thank you,
Mark.
everybody.
Thank you.
Thank
I like
you.
credit unions.
All right. Thank you.
Yeah.
Bye.
Thank you. Thank you so
Thanks,
much,
Mark.
Mark.
Thank you.
Good night, everyone.
Thank you so much.
Yeah. Hey guys, so for me, and actually Kelly, you and I were just talking about this today. Your very question is looking forward, and clearly the builders are wanting to build. They're offering incentives. I mean, every market that I'm looking at, where we have students on the team, the builders are offering incentives, and then the investors are always looking for deals, particularly flipping. Flipping, you just never goes out of style. But the rental market, to me, that's sort of the big sleeper. I mean, I just think long term, we're going to need more rentals. We do need more rentals. And if you can be a part owner of rental properties, you're probably going to do well. Appreciation and rent increases, So I think we're on the right track. I mean, I just don't think resales are going to be there on a percentage basis like they have in the past compared to new construction. I think there's going to be a lot of repurposing, office space turned into rentals. I mean, we were talking about this on a commercial mastermind today. I've seen churches turn into restaurants, breweries, and housing. I've seen office spaces turned into like dormitory style rentals. They'll have like a main kitchen living area, and all the little offices are people's bedrooms. I've seen all kinds of stuff out there. But the key is investors are creative, they're innovative, they're resourceful. They don't want to fail. They want to succeed. So they will take whatever property they've got and make it work. In fact, we're looking at it's a small monastery right now. It's a church with a monastery attached to it. And there's only 2 monks left alive, and they're being shipped off to Cleveland, Ohio to live somewhere else. This place, beautiful, modern, contemporary building. You can hardly even tell it's a church monastery from the street. Beautiful landscaping. And it's got like 22 individual rooms in there, plus multiple living spaces, couple kitchens, elevators, unbelievable scenery. And they're asking like $800,000 for it. I mean, the only problem there is the zoning, and I know the community because I'd invested there before. The citizens come out in droves to protest anything.
That's a 2-bedroom condo here in my town.
Yeah, I know, it's crazy. It's crazy. That place, if you made it like a business traveler type place, so it's an alternative to a hotel. It's in a neighborhood. It's away from traffic, away from noise. They got a giant piece of yard they can walk around, lots of parking, massive open, put a gymnasium there. That's the kind of stuff to go. But the neighbors around there, if you go to plant a tree, they will have a local hearing to protest you planting a tree. I'm not being sarcastic, of course, but that's the problem with that area. So, hey guys, any questions on anything we talked about tonight? Did you guys like that? You like having him on there? He's very
Yes. I think
a lot of
anything we can learn about
Oh.
financing, where to get money is helpful.
Yeah. Well, for me, it's education plus information, right? The team motto: education plus information plus action. equals results. And you can never get too much information, because it's not just what the data tells you, it's what you can do with it. I mean, how many agents do you know out there are wondering what to do? Do I do a postcard campaign? Do I go do some door knocking? Do I hand out a flyer? And the reality is you can do all that stuff. It all work to some degree or some level, but the reality is if you have data, you have information on properties and people, you can be a lot more targeted in your marketing, a lot more focused. You can speak the message that people want to hear. That's when you get a high response rate and high conversion rate. So, okay. Well, I feel like I'm doing all the talking, and I want to have you guys do some talking and questions. Let's see here. Kathy had to head out. Thank you, thank you,
Well,
thank you.
As for tonight, what I really appreciated for him is some of the little nuggets that he gave us. For example, don't focus too much on the prime rates. Look at the treasury rates to be as a better indicator as to where the market is going to move. I've never heard of that from any financial person. So that's
I agree.
Pretty cool.
Well, if you think about it, the treasury rate's more directly tied to the money. People buy treasury bills, based on their treasury rate. The prime rate is kind of like the driving force behind, all rates. But really, if you look at treasury rates, that's where your money is,
Yeah, when he said that, it was kind of like a forehead slapper. Like, well, wow, of course, but it just wasn't something that I thought. Of course, before that, I was like, what? That, yeah, okay, that was a 2%er for sure.
Yeah. Boy, I wonder if that guy could come to work for EXP. We need somebody like that, So, in any case, okay. Everybody okay? Anything you need help on? Even the guests, Kelly. Who else was on as a guest? I saw several people. They may have already logged off, but I mean, you got the help here. At least a dozen other compadres if you have something you want to share or get some insight on.
I did. Hi everybody. I did talk to Anna, and we're gonna meet this week for coffee. She's fantastic. Cool. And I think coming from California as a real estate agent after working in LA for 12 or 13 years, and then moving to Texas, I had buyers from California looking in San Antonio, their families here. And so they had sent me a list of homes that were 5, 10, 15 years old. And they're lovely homes, huge homes, mature trees, all those things. But when they started to walk through, they're like, oh, this flooring, I don't like it. That'll have to be replaced. And they start running numbers in their head, oh, okay, the house is, a great deal at 400,000, but I'm gonna have to put in at least another 100,000 to get it to where I want it to be. And at the end, they had said to me, do you have any new construction that's ready to go? And so I did. And we ran over and looked at it, and that was it. No, we want this. And it's really interesting to me because it's like, I mean, why wouldn't you buy new construction at this point? Because like the father was there and he was saying the windows are already like 10 years old, things like that. So I thought that was really interesting. But then you have those wonderful houses sitting there, and is there an opportunity to even flip and make them compatible with competitive with new construction? Would there be a way to lift them up somehow that people go, well, wait a second, that is an older neighborhood. I like it. Is there a way to do that? I don't know.
Well, there definitely is. And where you're living is one of the fastest growing areas, not just in Texas, but in the country. Yep. So I think it's just a matter of time before a lot of those resales, people start lowering their expectations. You realize, and if they don't sell whatever the price is coming in the offers, they're not going to sell. And the buyers more likely will be flippers or people that understand how to remodel, add value. And that's exactly what happened in California. In a lot of markets there, these places weren't dumps by any stretch of the imagination. But look at like Santa Barbara. These are beautiful old Santa Barbara homes. They just had old kitchens and old everything else, but they were nice and beautiful landscaping. And people were buying them for 600,000, remodeling them and selling them for 900,000. So, but it wasn't like they were dumps. They were, by most people's standards, they were nice homes. So I think you'll see that in some of the fast growing markets like Austin, San Antonio, Nashville. I mean, there's several markets that are like that. I mean, remember guys, look at what we call the money states, the green states. And it's not always politically, not always the red states versus the blue states. It's not. It's, Oregon and Washington State are both green states. They're growing like crazy. People are moving there, mostly from California. In fact, I don't know who the heck's in California because everybody I talk to say, well, all my folks are coming from California. And it's Colorado, everywhere, saying the same thing,
Yeah, leaving in droves for years.
Yeah, Florida too.
Yeah, I was going to say, speaking to that kind of the price point thing is here locally, Tampa, everything that I'm seeing across the board almost consistently is talking about the ridiculousness of the overpriced in Florida. And so on one hand, you have what happened with COVID, right? People are buying $100,000 over asking price, over list, no contingencies, sight unseen sometimes even. Well, that's going to go badly. That's not going to be a good thing for very long. So now we're past that, and those are the price points. People are in those homes that they've paid for at that price point. What's happened on the numbers side of it is that now there's parts of St. Petersburg where literally 58% over market. 58%? And then the median over percent is 43 or something over. Okay, so just call it 58 and 43. Okay, let's call it 50. So if you're looking at a $500,000 house, you're telling me that it's $250,000 overpriced? Yep. I'm not telling you that. The market's telling me that. So what do I tell my client who's looking to get a home they can't get what they want, so they got to pay that 500, 600 price point. 6 months from now, it's going to be falling. It's not going to be 300,000 from 6 in 6 months, but it's not going to continue to go up. The prediction is already what they're calling free fall. And it's kind of scary here. So Gary, if you're coming on vacation, you're looking at homes and I'm taking you around, I really feel hard pressed to encourage you to spend that 500,000 or 600,000 when I feel like I know if you come back and we do the same task in October, you're going to get more house for less money. Yeah. And from an integrity point of view, I mean, I know we're guessing, man, but it's really.
Well, I mean, I was down there in fall of 2007. If you guys remember that, anybody who's in the business, late August is when the stock market finally started tanking. And then throughout September, October, November, it was a free fall. And I was in Delray Beach at a guy named Frank McKinney's house at an event there. And I was one of the guest speakers. And there were people who were buying a lot of pre-construction condos. They were basically buying a piece of paper. And then the bottom just dropped out. The banks, they couldn't get money. So the builders stopped building. And there were the white pipes sticking up out of the ground. And that was it. There was no cement, no concrete, no wood, no anything. And people lost their shirts and people were crying. What do I do? What can I do? And I'm like, I don't know what to tell you. You either let it go to the bank or you try to stick it out. You can't rent it out because there's nothing around. It wasn't built yet. You bought something that before it was built and the builder's gone or bankrupt. There's not a thing you can do. It was horrible. I mean, prices dropped 50%. It was fast.
Yeah, I think I was with Toll Brothers and we were buying some, luxury townhomes, and I had $35,000 that I was looking at walking away from. And the deciding factor basically is if you get five different people all building in the same complex and basically for the investment purpose, when they all come due and they're all finished built, what do you got? You got basically the same property all in the same building. Maybe you're on the end, so you got a window and your neighbor doesn't, or maybe you're looking at water and he's looking at trees, or he's looking at a parking lot or whatever. But we were all basically holding the same thing at basically the same price point. And when I looked at what happens if I close on this, about 4.5 months after closing, when you started to amortize what that would look like, at that point it was going to start costing money. And then I thought, okay, going into 2008, how quickly am I going to be able to sell this thing? I'm not sure. And I'm not sure when I got a whole development full of basically the same thing that I'm holding, can I do this in 4.5 months? Probably not. Yeah. So we just didn't close. We just forfeited our 30 grand down. And then I had friends who did the same thing, like literal people in my life that did the same thing. And then other people decided to close it. 6 or 8 months later, they regretted it. And then when you say losing your shirts, it was not fun. I mean, I felt bad for them, but
Well, keep in mind too, the wild card is the shortage of housing. It's almost all over, and it's somewhere between 4 and 7 million. I mean, you could watch the news tonight, and it'll say 4 million, and watch another news tomorrow, and it'll say 7 million. Somewhere in there is the truth. And I think it's closer to 7 million personally. That's just my own opinion. That is a lot of houses. That's a lot of units. And I don't care how many builders we have. That takes a long time to make up, probably 3 to 4 years. So how that's going to impact what we just talked about, like is the decline going to be as rapid? Is it going to be as far? Is it going to happen at all? I mean, all we can do is say, let's just see what happens. I think the builders are stepping up to the plate. I do think we'll see a price drop because we always do anyways in election year, so look for that. But the reality is the underlying impact of inflation is very real. And guys, I want you to keep this in mind. I learned when I was in banking to not listen to what they're telling you on the news when it comes to inflation, because they're taking what they call a basket of goods. The basket of goods today that they're basing inflation on is not even close to what it was 10 years ago and 20 years ago, 30 years. They manipulate it to make the rate of inflation look lower. They purposely leave out things like energy cost, right? If you look at, I'll just tell you this, you can do this on your own. Look at all the money you spend on an annual basis and map it out on an Excel spreadsheet. All right. And then order it from most expensive to least expensive. So most expensive at top would be your housing cost, your automobile cost, so forth. And at the bottom would be shaving cream, right? So you're sorted by price. Then you look and see what the rate of inflation was for that commodity going back 5 years or 10 years, whatever you want to do. You can compare the price of shaving cream from 10 years ago today. Put that in the next column, the rate of increase for that commodity. Okay. And the third column is you have to put in the frequency of purchase. How often do you buy gas? Every week. How often do you buy shaving cream? Every 3 months or something? You got to look at the frequency of purchase. Okay. Like mortgage payments is every month. Then the final column is when you multiply all that out, you get a real true in your pocket inflation rate in terms of dollars, not percentages. That's how you calculate real inflation. And when you do that, it's well over 30%, right? That is dramatic. And that's just in a couple of years. It's not like that's over 10 years. That's just in the last 2 to 3 years. That's what people are feeling. That's what Mark was saying. You got to remember what people are feeling in their pocket when they go to the grocery store and they go to the gas station. You can't ignore it. That's real. It's real for everybody. So having said all that, I can tell you from looking at our transaction volume at EXP and a team and every organization, it's weird, but it's on the uptick. Our transaction volume was on the uptick year to date, last July to this July, where last July was very low, extremely low, but yet last April, May, and June were extraordinarily high. So I think what I'm seeing is pent up demand is just starting to loosen up. People are just tired of waiting. They only care so much about how much gas is costing. They're like, I want a darn house, and you're just going to get whatever they can get. So I think that's why you're seeing, plus the builder incentives. I think that's why we're seeing an increase in transactions. A lot of it is new construction. New construction versus resale is way up. Usually resale is a bigger part of the market. Not right now. New construction is a much bigger part of the market. That's just this year. It's just really this year. In any case, I'm going to quit rambling, guys. I just want to leave you with that. The bottom line is always this. You got to look at the data, look at the facts, determine where's the need and how do you serve. And it just comes down to new construction and investing. So you wake up in the morning and you do marketing based on those two markets. You hit the ground running. You don't slow down. All you got to do is run faster than the realtor next to you, right? And that's not hard to do because 80% of realtors are not hustling. They're part-timers, they're whatever. I'm not knocking them. It's just that's not your competition. The competition is the top 20%. So your job is just start a minute earlier, end a minute later, take one more step than the next guy. And I promise you're going to get your fair share of pie. So,
Yeah, anybody
Yep.
who doesn't believe that, they could be in my shoes this weekend. Take a guess how many people don't answer their phone. Ridiculous. I mean, really?
yeah.
I mean, I know that's a
Yeah.
joke and that people say that, but it's so true. And I know it was a holiday weekend and I get all that, but even today, Monday, nobody's answering their phones. I'm like, if I'm the seller, I'm going to be not pleased with you as my choice of realtor, but
Yep.
I don't know.
Well, Rob, give me a call tomorrow or Wednesday or Thursday. I do want to catch up with you. I know you were out with your folks, and I'm gathering that's what that remark was related to, was
Yeah.
being able to line up showings for them.
Right. Yeah, for sure.
Yeah. But set up a call or just call me. Let me know when you're free. I always keep a chunk of time open during the week. Every day actually. So yeah.
Absolutely. You want me to call tomorrow? Give you a call?
Yeah, call. Well,
Or
tomorrow's actually pretty bad.
okay.
Wednesday would be way better. Yeah, much better.
Okay.
Like mid morning, mid to late morning, early mid afternoon. Those would be really good times. So
And what
that
time
goes for
zone are you in now? What time is
Yeah,
what time zone are you in right now?
like 10 to noon Wednesday or 1 to 3 Wednesday. And that goes for everybody here. If you need something you need to discuss and you can't wait for a strategy call, just remember those times are right now looking pretty good.
And what time zone are you in now?
Oh, I'm sorry, East. Sorry, my hearing's gone bad. Eastern time zone.
Okay.
Yeah.
I'll hit you for sure. Thank you for that.
Yeah. Well, listen, guys, thanks for participating. Thanks for sharing, asking questions. And thanks most of all for learning and taking notes. Look forward to seeing you on your one-on-ones. Remember, this Wednesday night is the monthly team call. So it's the second Wednesday of every month. And we'll go over a couple things there. Renovos is looming large. It's another product we can get through EXP that people are having a big success with. And Bonetta, if you're still here, hey, Bonetta. Would you mind being on Wednesday night, Bonetta, and talk about the EXP challenge that you're involved in?
Can you hear me?
I can now. Yep.
So hi, everybody. So I'm doing
Hey there.
what is called the Fast Cap training. It's a 6 weeks training. They invited about 1,000 EXPers and about 300 of us are participating full time. This is a 6-week challenge, 3 days a week. So Kendra and I are doing it together. And they take you from A to Z in real estate. So a new person to experienced person. So you could join as a mentee, mentor, a student, an observer. You can join. And so they started out with this prototype, sort of like, and then they're going to advance it to the rest of EXP. So it will be rolling out to everybody. So this first 6 weeks, and it's free of charge. It doesn't cost anything. It's intense.
Wow.
You got lots of homework and lots to do, and I'm juggling that, and my business has picked up. Like Gary said, the business is starting to pick up. Thank you, Jesus, because last year was sad. So
Yeah.
so we're doing that. I mean, they're doing everything that, from where the license ends to where it really should pick up before anybody gets into real estate. It really picks up. It's like the fast start. What is that we did? The fast. What is that we did?
90-day fast start. Yeah.
Yeah, this is on steroids.
Awesome. Okay.
Well,
Yeah. Tell us more. Show us more on. I'll promote you Wednesday, and you can share what you got so far. And Kendra, it's good to see you too, Kendra. I'm glad you're doing this with Bonetta.
because it's in the background. Hang on a second.
Yeah. Couldn't ask for a better partner. So. Yeah. Okay. Well, listen, guys. So I hope you have a good rest of the evening. I appreciate you staying on. The good stuff always seems to come towards the end, So be on Wednesday night. We got a few things to cover. Nothing real intense. And I'll look forward to seeing you then and seeing you on the one-on-ones.
Thank you for watching this episode of Monday Night Live. Be sure to subscribe to our channel and go to realestatewithgarywilson.com to join our community and start building wealth today.